It's the Larry Kudlow Show. Free market prosperity starts here. Now, here's Larry Kudlow.
Welcome back, everybody. I'm Larry Kudlow. This is the Larry Kudlow Show. We'll reset. By the way, you can join us on the Internet. You can live stream us on the Internet, LarryKudlowShow.com. LarryKudlowShow.com. Plays all across the country, around the world, throughout the solar system. And we're picking it up in the Milky Way. That's what the numbers show. And during the week, please join us. Fabulous Fox Business Network. The name of the show is Kudlow. It plays 4 to 5 p.m. every day, Monday through Friday. And if you can't get us at 4, why, just text your favorite 9-year-old, and she will show you how to DVR the show. All right, we're going to do some stock market work. Stephanie Link, Chief Investment Strategist of Hightower Advisors and Head of Investment Solutions, and Kenny Polcari, Case Capital Advisors and Slate Stone Wealth. So welcome, kids. Okay, Kenny Polcari, what's going on? that's the most analytic. That's the most analytic question I can think of. What's going on, man? This is wild stuff.
It is wild stuff. But you know what? I don't necessarily think for many of us that it was unexpected. Maybe the way it happened, that surprise rate cut in Japan that caused that whole Japanese carry trade to come undone on Monday, causing all that chaos amongst that community that engaged in that trade, and then igniting the algos on the way down. And then it created fear in the markets, which I completely understand. But, you know, there's two things there. The number, when you look at the physical number, like the Dow was down 1,200 points, that number scares people. But if you look at the percentage itself was not necessarily, a disaster, right? But one way or the other, it needed to happen. Market, I think, was stretched. We had stretched valuations across tech. We saw what they did in the tech industry this quarter, as they started reporting their earnings. If they were not priced, if the earnings were not exactly what the street was looking for, and then some, they punished them. And they punished them for, in my opinion, a lot of them for no reason at all. But they did, and that ignited kind of this pullback, which I actually think is quite healthy. It was chaotic for sure on Monday. But then the rest of the week, we had this whiplash up and down, up and down, up and down, which is going to continue to happen until we get more clarity, not only on rates, but we get more clarity on the economy, and then it finds a place of stability. But don't forget, we're in a weak time of year. August to October is seasonally weak, so investors should understand that. And so this is not necessarily something that was unexpected. Maybe, like I said, the way it happened might have been unexpected. But the fact is, I think we're going to continue to trend a little bit. Maybe 51.19, which is a low on Monday, will be the low at this time of year. But I suspect we're going to at least test that again before it's over. And then I think we'll be good.
Well, the S&P 500 is still up 12% year to date. It's still up. Correct. By the way, you meant rate hike in Japan, not rate cut. Rate hike.
No, what did I say? Cut? No, I meant hike.
But yes, because first of all, that killed the yen carry trade. Money was not as cheap, and it also killed the currency trade. Right? People were buying a zero rate with a sinking currency. Then all of a sudden, it was a slightly higher rate with a rising currency. So, Stephanie, the yen carry trade was kind of destroyed. One question I have, though, Steph, on this whole point is the carry trade borrowing amount, have we played that out, or is there more correction that might have to come?
Well, I'm not the expert on the yen carry trade unwind, but I will say that a lot of the things that I've read suggest that maybe we're three-quarters of the way through. I think we, as Kenny mentioned, August, September are the worst 2 months of the year for the market. So the yen carry trade unwind was certainly a part of it, a big part of the sell-off last Friday and Monday. It's also last Friday, not this past Friday, but 2 Fridays ago, remember we got the non-farm payroll numbers, and that was a disappointment. And so all of a sudden economic growth came into play in terms of the uncertainty. The Fed being behind the curve, or what the heck the Fed was going to do or will do, was also a big question mark. And, of course, let's not forget the elections. Even though it's kind of like not really front and center for the markets per se, it certainly has been interesting, and I know you're the expert at that. So all of these things created a lot of volatility, enormous volatility.
Well, we lost her.
But let me just
jump in. But one other thing, I was interested that bond yields came back. So the 10-year closed at 394. It had fallen down to about 365.
Yeah.
The 2-year went back up 17 basis points. I'm not sure what that means, except there was just kind of a return to normalcy as the week wore on.
Right. There was actually 2 weak bond auctions this week, right? Weaker than expected in terms of demand. Listen, when bond yields fell and bond prices rallied, it was on all that chaos and people, jumping out of stocks and into bonds and into fixed income and safety and all that stuff. And so as the week calmed down and we seem to be getting some different information. And by the way, that whole call for an emergency Fed meeting, an emergency rate cut, the word emergency suggests panic in and of itself, which, by the way, didn't help the chaos, right? Once the Fed came out and made it clear that there was going to be no emergency meeting and no emergency rate cut, then I think you started to see that return to normalcy. And while people may still be a little bit anxious, I don't think the Fed is at all going to find himself backed into a corner. I don't think this time he's going to stand up and say, listen, we're waiting until September. What happens in September, we all suspect there's going to be a rate cut. Now, is it 25 or is it?
We don't know that. We don't know that yet. Because you got it. You got 2 CPIs and a jobs number before they meet in September. We don't know what they're going to do. They don't know. They never know. I mean, Trump was right at the news conference. There are years that they're early, they're late. He wants to weigh in. Everybody wants to weigh in. The futures market wants to weigh in. The futures market's been wrong for 2 years on the Fed. I mean, I don't know. I'm just saying, Stephanie, there's a rumor that you're back, which we're...
I'm so sorry. I don't know what happened.
That's all right, love. This is delighted to have you. The point is, we have, 2 CPIs and 1 jobs report before the Fed's September meeting. And I'm just saying this idea that they're definitely going to cut and or that they're going to cut twice. We don't know that.
No, I don't think they're going to cut twice, actually. You have an Atlanta Fed tracker that's running at 2.9% growth. You had initial jobless claims this past week that actually fell. You had an ISM services number that was better than expected on Monday, which is why the market stabilized on Monday. And if you look within the ISM services, as I know you and Kenny do, new orders and employment were better than expected. So the point being is, the Fed should start to cut because inflation has come down, running at about 2.5%. And that's what they're looking at. And the labor market, certainly, it's softening a little bit, but it's not collapsing. Economic growth is good, but they don't need to be this restrictive. So Jackson Hole, August 23rd, I think he comes out, Powell says, we're going to cut. And I think it's 25. And I do not think they need to do 50. But I do think they need to embark on a whole cutting cycle. But I would just say one last thing before I got cut off. Volatility is here because we have seasonality and we have a lot of unknowns. But at the end of the day, Larry, you taught me this 18 years ago. Stocks follow profits on the way up and on the way down, and profits are going higher.
Yeah, they are. No, I happen to agree with that. I think the Magnificent Seven is overvalued, but basically I agree. Somehow the country is going to be left standing. We're okay. This is still America. I got to go short today, folks. I appreciate you very much. Stephanie Link, Hightower Advisors and Investment Solutions, Kenny Polcari, Case Capital, and Slate Stone Wealth. I'm Kudlow. After this, we got a big surprise. We're going to have a gold expert talk about, by the way, gold has outperformed stocks in the last 25 years, folks. I bet you didn't know that. I'm Kudlow. We'll be right back.
This is the Larry Kudlow Show.